Warren Buffett has spent over 6 decades building Berkshire Hathaway into one of the largest, most successful investment vehicles in history through the careful, individual selection of specific businesses: Coca-Cola, American Express, Apple, Bank of America. Decades of meticulous research, deep company analysis, and concentrated positions in businesses he understood intimately. This is the same man who instructed the trustee managing his estate after his death to put 90% of the cash left to his wife into a single low-cost S&P 500 index fund and the remaining 10% into short-term government bonds, and to do absolutely nothing else. No stock picking, no active management, no attempt to replicate the strategy that built his own fortune, just one index fund left alone. This instruction appears in his 2013 letter to Berkshire Hathaway shareholders, and it is one of the most quietly significant pieces of investment guidance ever issued, precisely because of who issued it. If Warren Buffett, the most successful active stock picker in modern financial history, a man who has generated investment insight that most professional fund managers spend entire careers failing to replicate, believes the correct approach for ordinary investors, including the people he loves most, is the simplest possible strategy available, that recommendation deserves serious examination. This video explores exactly why Buffett made this recommendation, what the evidence shows about why his own approach doesn't generalize to ordinary investors, and what his specific instruction means for how you should be investing your own money. If you're into this kind of content, take a second to subscribe. And if this video helps you at any point, tap that like button. It really helps the channel. And now, let's get into it. Part 1. The instruction itself and why it surprised so many people. In his 2013 annual letter to Berkshire Hathaway shareholders, Buffett described the instruction he had left for the cash portion of his estate that would go to his wife after his death. The instruction was specific. Put 90% into a very low-cost S&P 500 index fund and 10% into short-term government bonds, and he suggested Vanguard's fund specifically as a low-cost option. He went further than simply stating the allocation. He explained his reasoning directly. He believed this simple strategy would produce superior long-term results compared to hiring high-fee investment managers, including, by clear implication, professional managers employing the same kind of active stock selection that defines Buffett's own career and reputation. This recommendation surprised many people specifically because it seemed to contradict Buffett's entire professional identity. Here was the most celebrated active investor of his generation explicitly telling the people closest to him not to attempt anything resembling what he does for a living. The contradiction is resolved once you understand the specific, well-documented reasons Buffett has given, repeatedly across decades of shareholder letters and public statements, for why his own approach works for him and fails for almost everyone else who attempts it. Part 2. The Berkshire Hathaway Bet. 10 years of proof. Buffett did not simply state this belief abstractly. In 2007, he made it concrete through a public, structured wager. He offered $500,000, wagering that over a 10-year period beginning January 1, 2008, a simple, unmanaged S&P 500 index fund would outperform a portfolio of 5 hand-selected funds of hedge funds, chosen by a professional investment manager, specifically for their perceived ability to beat the market through active, sophisticated stock and strategy selection. Ted Sedes, co-manager of an asset management firm, accepted the bet on behalf of the actively managed side. The result, after the full 10-year period concluded, was decisive. According to Buffett's own account in his 2017 shareholder letter, the S&P 500 index fund returned approximately 125.8% cumulatively over the decade. The basket of actively managed hedge funds chosen by CDs returned approximately 36.3% cumulatively over the same decade, meaning the actively managed funds, despite charging substantially higher fees and employing professional managers specifically selected for their stock picking and strategy expertise, returned less than a third of what the passive, unmanaged index produced over the same decade. Buffett's own explanation for this result, articulated in that same letter, centered specifically on fees. The hedge funds involved in the wager typically charged a 2-and-20 fee structure, a 2% annual management fee regardless of performance, plus 20% of any profits generated. Over a decade, this fee structure compounds into an enormous drag on returns, particularly because the fees are charged whether or not the fund actually outperforms its benchmark, meaning investors paid substantial fees year after year for performance that, in aggregate, badly trailed what they could have achieved for a fraction of the cost in a simple index fund.
Part 3. Why Buffett's own track record doesn't generalize. The natural question this raises is direct. If active stock selection underperforms index investing so reliably, how has Buffett himself produced decades of market-beating returns through exactly that approach? Buffett has addressed this directly and repeatedly, and his explanation is specific rather than falsely modest. He has stated, across numerous shareholder letters, that the skill required to consistently identify undervalued businesses, the resources required to conduct the depth of research his approach demands, and the structural advantages Berkshire Hathaway possesses, including access to private deal structures unavailable to ordinary retail investors, the ability to acquire entire companies rather than simply trading shares, and decades of accumulated relationships and reputation that bring him investment opportunities other investors never see, are not capabilities available to the typical individual investor, regardless of how much time or effort that investor dedicates to the attempt. He has also been explicit in multiple letters that the overwhelming majority of professional money managers, people whose full-time job, unlike the average individual investors, is exclusively dedicated to security analysis, fail to outperform a simple index fund over any meaningful time horizon once fees are properly accounted for. This is not a marginal or contested claim. It is extensively documented by independent research conducted entirely outside of Buffett's own commentary. S&P Dow Jones Indices publishes the SPIVA report, Standard & Poor's Indices versus Active, twice annually, tracking the performance of actively managed active funds against their relevant benchmark indices across multiple time horizons. The most recent reports consistently find that over a 15-year period, approximately 85 to 90% of actively managed large-cap U.S. equity funds underperform the S&P 500. This finding has remained remarkably consistent across multiple years of the SPIVA report, multiple market environments, and multiple economic cycles, suggesting the underperformance is structural rather than a temporary feature of any particular period. If the overwhelming majority of professionals whose entire careers are dedicated to this exact task fail to beat a simple, unmanaged index fund, the implication for individual investors attempting the same approach part-time, without professional training, institutional research resources, or the structural advantages Buffett himself has identified as central to his own results, is unambiguous. Part 4. The mathematics of fees made concrete. Buffett's explanation for the gap centers specifically on cost,
And the mathematics behind this explanation are worth making fully concrete, because the difference between fee structures that sound similar in percentage terms compounds into dramatically different outcomes over long investment horizons. A low-cost S&P 500 index fund, such as the kind Buffett recommended in his estate instructions, typically charges an expense ratio in the range of 0.03 to 0.04% annually, a cost so minimal that on a $100,000 investment, it amounts to approximately $30 to $40 per year. An actively managed mutual fund, by contrast, typically charges an expense ratio in the range of 0.5% to 1.0% annually, according to Morningstar's fund fee research. And many hedge funds, like those involved in Buffett's wager, charge considerably more through the 2 and 20 structure described earlier. On a $500,000 portfolio growing at a hypothetical 9% gross annual return before fees over a 25-year period, a fund charging the low-cost S&P 500 indexed fund's 0.04% expense ratio would grow to approximately $4.2 million. The identical portfolio in a fund charging the 1% expense ratio, a fee difference of less than 1 percentage point annually, would grow to approximately $3.4 million over the same period. The fee difference alone, compounding silently and invisibly over 25 years, costs approximately $800,000 in final portfolio value, despite both funds capturing virtually the same underlying market exposure. This is the central mathematical insight behind Buffett's recommendation. Even if an actively managed fund were to perform exactly as well as the market before fees, which the SPIVA data suggests is itself a generous assumption for the majority of active funds, the fee structure alone would still leave investors with meaningfully less wealth than the simple, low-cost index alternative. Part 5. What buy the whole market actually means in practice. Buffett's specific recommendation was an S&P 500 index fund, which holds shares of the 500 largest publicly traded companies in the United States, weighted by market capitalization. Understanding what this actually represents clarifies why the strategy works as well as it does. When you invest in an S&P 500 index fund, you are not betting on any single company, sector, or economic outcome. You are purchasing a proportional share of the aggregate American corporate economy, spanning technology, healthcare, financial services, energy, consumer goods, industrials, and every other major sector simultaneously, in proportions that automatically adjust as companies grow, shrink, get added to the index, or get removed from it. This structure provides automatic diversification that eliminates a specific risk every individual stock picker faces, the risk of being meaningfully wrong about any single company. An index fund investor who holds a small position in a company that ultimately fails experiences a minor drag on their overall portfolio because that company represents a small fraction of the total indexed. A concentrated stock picker holding a significant position in the same failed company experiences a far more serious loss because their capital was concentrated rather than spread across the entire market. The S&P 500's long-term historical performance reflects this structural advantage. According to data compiled by S&P Dow Jones Indices, the index has produced an average annual return of approximately 10% since its modern 500-company formation in 1957 through 2024, a figure that incorporates every recession, every market crash, and every period of economic uncertainty that occurred during those nearly 70 decades, and that reflects the aggregate growth of the American economy rather than any individual prediction about which specific companies would succeed.
Part 6. The behavioral argument. Why simplicity itself is the advantage. Beyond the cost and diversification arguments, there's a third, equally important reason Buffett's recommendation makes sense for ordinary investors specifically, and it relates to investor behavior rather than investment selection. Dalbar's long-running quantitative analysis of investor behavior consistently finds that the average individual investor underperforms the very funds they invest in by a meaningful margin annually, not because they chose bad funds, but because of behavioral decisions made around those funds, selling during market declines, chasing recently outperforming sectors or funds, and generally trading more frequently than a buy-and-hold approach would suggest, each of which has been independently documented to reduce realized returns relative to simply holding an investment continuously. A complex investment strategy, one involving multiple individual stock positions, frequent rebalancing decisions, sector rotation based on economic forecasts, or active attempts to time market entries and exits, creates substantially more opportunities for these costly behavioral errors than a single, simple index fund position does. Every additional decision point in an investment strategy is an additional opportunity for emotion, fear, overconfidence, or simple misjudgment to interfere with what the underlying mathematics of long-term compound growth would otherwise reliably produce. By recommending a single index fund with no individual stock decisions to make, no sector rotations to consider, and no active timing decisions required, Buffett's instructions specifically minimizes the number of opportunities for his wife's trustee, or anyone managing the estate, to make exactly the kind of behavioral errors that the Dalbar research consistently identifies as the primary driver of underperformance for ordinary investors. The simplicity is not merely a cost-saving measure, it is also, independently, a behavioral safeguard.
Part 7. What this means for your own money. Buffett's recommendation and the extensive independent research that supports the reasoning behind it translates into a specific, actionable framework for an individual investor managing their own retirement and investment accounts. The first implication is direct. For the vast majority of individual investors, a low-cost, broad-market index fund, whether an S&P 500 fund specifically or a total U.S. stock market fund that includes mid-cap and small-cap companies alongside the large-cap companies the S&P 500 covers, represents a more reliable path to long-term wealth accumulation than attempting individual stock selection, hiring an actively managed mutual fund, or paying a financial advisor to select and frequently adjust a portfolio of individual securities. The second implication concerns fees specifically. Every existing investment account, every 401k, every IRA, every taxable brokerage account should be reviewed for its expense ratios, with any fund charging meaningfully more than the 0.03 to 0.10% range typical of low-cost index funds, evaluated against whether the historical performance, after fees, has actually justified that additional cost. Given the SPIVA data showing 85 to 90% underperformance rates for active funds over long horizons, the likely answer for most actively managed holdings is no. The third implication concerns behavior rather than fund selection. The specific power of Buffett's recommendation comes not just from choosing the right investment, but from the explicit instruction to leave it alone, to avoid the temptation to actively manage, adjust, or second-guess the position based on short-term market movements, news events, or the performance of other investments that might appear more attractive in any given moment. The fourth implication concerns scale and applicability. Buffett's recommendation was made for his wife's inheritance, a context involving significant wealth, sophisticated financial guidance if needed, and a multi-decade time horizon. The underlying logic, however, applies with equal or greater force to an ordinary working individual building a 401k or IRA from a modest income, precisely because that individual typically has even less time, expertise, and resources available to dedicate to active investment management than a sophisticated estate would, making the case for simplicity, low costs, and broad diversification arguably even stronger for the average person than for Buffett's own family. Warren Buffett built one of history's great fortunes through 6 decades of intensive, skilled individual company analysis, a level of expertise, access, and structural advantage that he has explicitly and repeatedly stated does not generalize to ordinary investors, including, by his own clear instruction, the people he loves most. His recommendation was not modest false humility, it was a direct application of extensive evidence, his own public 10-year wager, decades of SPIVA research on professional fund manager performance, and well-documented research on behavioral costs that complexity introduces for individual investors, concluding that the simplest possible strategy, consistently and patiently applied, outperforms the vast majority of more sophisticated alternatives once fees and behavior are properly accounted for. The instruction he left for his own estate is available to anyone, at any income level, starting today. A low-cost, broad-market index fund, a small allocation to short-term bonds for stability, no active management, no attempt to beat the market, no individual stock selection. If that strategy is sound enough for the man whose entire professional reputation was built on doing the opposite, it is very likely sound enough for the rest of us.